My name is Sandile Shezi. I'm a currency trader, forex trader. I'm a mentor, and I've been in this particular industry for quite a while now. In fact, this month is a very special month for me because I'm celebrating 11 years as a trader, retail trader that is. And I'm super excited to actually be sharing some very valuable information with you, right? I believe there's so much that we all gonna learn. There's so much we're going to benefit. There is, a lot of empowerment that's gonna take place on this webinar. I see Lesotho's represented, Zimbabwe, Dylan, I see you. Botswana, I see you there, Motusi. Namibia's represented. I've had the great opportunity of literally traveling around Africa, even outside of Africa, and introduce people to this industry, mentor people in this industry, help people to really become successful in trading. I see Swaziland is also represented. Stelo, I see you. Thank you so much. Great stuff. We're about to get started. So my advice to you is take as much notes as you can. Take as much notes as you can. Try and focus as much as you possibly can, right? And let's leave the questions towards the end, right? Because as I continue with this webinar, it's going to be difficult for me to keep, focusing on what I want to share with you and deal with questions at the same time. So if you've got questions, just note the questions down. And then towards the end of the webinar, I'm going to try and tackle all the questions, guys. One thing though is please don't share your numbers, right? Please don't share your numbers with me or with anybody, because you are going to get deleted off the webinar. Please don't share your number, don't share your email. We've got your information. We're going to send you everything you need regarding this webinar, right? I want to just dive straight into it. So I've been doing this for 11 years, as I said. Started back in 2009. Made millions within this space. It hasn't been easy. It's been a really interesting journey. I've had my ups, I've had my downs, and the reality is, if I was to relive this entire journey of mine, right? If I were to redo everything, start from scratch, believe me, I would still go for Forex. And the reason why I would still continue or relive it as a trader is because this is the largest market in the world. When we talk about Forex, we are talking about the largest market in the world, right? We're talking over $5 trillion that is traded every single day, right? I hope you heard that right. I'm not talking about billions. I'm talking about $5 trillion that is traded every single day, Monday to Friday. So all we got to do is try and get a piece of that pie, right? And that is, in a nutshell, why we on this webinar, to try and get, the biggest bite that we possibly can of this massive pie. Now, just in case you're wondering, why is it so big? Why are we talking about trillions and not billions? Is because the Forex market, we are referring to a marketplace, a decentralized marketplace where global currencies, not the stock market, where global currencies get traded every single day. We're talking about pounds. We're talking about euros. We're talking about dollars. We're talking about Swiss francs, Japanese yens. There's so many different currencies all over the world that are traded in this market, right? And the nice thing about it is we can trade any time of the day. The only time the markets are closed is Saturday and Sunday. Monday to Friday, we can trade, during the day. We can trade in the morning. We can trade in the late hours of the evening, which means if you are working or studying, you can continue doing what you're doing. And after hours, once you leave work, you can then start trading. Or, after you have dinner with your family, you sit down in front of your laptop and you trade. You can even do it on your cell phone, right? So for me, I believe everybody around the world should be trading. There's absolutely no reason not to trade. I say this to my team all the time, that If your phone doesn't make you money, it's not a smartphone, it's a dumb phone, right? Our phones should be helping us make money every day, not spend money just chatting with people. We should be making money from our phones, and that is why I'm here. I want to help you. I know there's some of us who are already traders. There's some of us who might have never traded before, but I believe all of us are looking for one thing, and that is to make money, not once off, but consistently, right? If you are looking at making money once off, you probably go and play the lottery or go and sit in the casino. But every single one of us in this meeting, we are looking for something that works. We are looking for a system that works. We are looking for something that is sustainable, something that we can do over a long period of time, right? Which is why I decided to get into this industry, because I realized that trading, I realized this at a very early stage, that trading is not gambling. Trading is not a get rich quick scheme. Trading is not, is not for people who are lucky. I know a lot of people believe in luck, but it's not people who are lucky that make it in trading. It's people that are focused, that are determined, and people who have a hunger to succeed, right? It's like any other business. You just need to learn and understand how everything works. Now, the beautiful part about it is it's not the same. It's not the same as, buying trucks and getting into logistics. It's not the same as starting a restaurant or opening a retail shop. Those are assets that can make you money, right? The challenge with that is somebody can steal your truck, somebody can burn down your shop, somebody can do, somebody can damage, whatever it is that is making you money. The beauty about this is a skill. This is a skill. And once you get the skill, once you understand it, nobody can take it away from you. Nobody can take it away from you. Once you master how the market works, you can literally make money for the rest of your life. Whether you're sitting at home, whether you're at work, whether you're at the beach. And that is why, I love what I do so much. Now, let me ask you guys a question before I get ahead of myself. How many of us are new to trading? I'm sure there's some people on this meeting who've never traded. You probably saw an advert and you're like, hey, Sandile is hosting a webinar. Let's jump in and see what is he going to be talking about. But you probably have never traded. You're probably a little bit skeptical at the same time. You're asking yourself, is this thing real? Is this thing not real? Is it legit? Can I really do it for a living and be able to sustain myself and my family? I'm sure there's quite a few of us who might be feeling that way. If you're one of those people, please let me know in the comments. Just type new. I see Tabi, so you're new. Anybody else is new? Anybody else is new? Anybody else is new? Anybody else is new? Let me know. Let me know. And at the same time, I know for a fact that there are some of us on this webinar who've been trading. You know what Forex is, you know how it works, but you've got one problem. And your problem is you are not making money consistently. You make a bit of money here, you lose it tomorrow. You make money today, you lose half of it tomorrow. So I know some of us might be facing that challenge right now. And believe me, I've been through that. Where you make money today, you lose all of it tomorrow. You make money the following day, you lose all of it. You keep pumping money into your account. And you're now beginning to ask yourself, is it really worth it? Should I continue with this thing? Should I give up? Should I maybe go and look for a job? I've come across a lot of people like that. If you're one of those, just say losing. Just say losing. Just type the word lose. Lose or loss or losing or I'm losing, whatever you want. I see a lot of new traders stopped out, not making money consistently. All right, great stuff. Awesome. Losing. All right, so I think we've got an amazing team tonight. We've got an amazing, this webinar is so diverse. There's so many people who are new. There's so many people who know what trading is, but you keep losing money. So I think we've got a very nice balance of people that are losing money and people who are new to trading. So I want to start off by addressing those of us who are new, right? I want to first start off by helping those of us who are new. Then I'm then gonna assist those of us who are losing money. So I want to help those of us who are new to try and catch up, and then we can all move together. So for those of us who are new, when we talk about Forex, we talk about a decentralized market, as I alluded earlier on. This is a global market, right? It's not just a South African thing, or a Zimbabwe, or Botswana, or Namibia, or Swaziland, or Lesotho. It's global, right? It's the biggest market and most liquid market in the world, right? Now, what we want to do is, as these global currencies, are being traded, people are trading around the world for different reasons. There's what we call retail traders. There's institutional traders. People are trading currencies all over the world for different reasons. Some people are traveling. That's why they're exchanging currencies. Some people, are either importing or exporting commodities. That's why they're trading. Remember, countries cannot do business with each other without actually trading Forex. If I need to import or export goods, depending on whichever, I might find myself in that position where I need to exchange maybe my rands to dollars, or exchange my rands to pulas, or exchange whatever, So people trade for different reasons. And that's why when we watch the news, you might see that today they'll say the rand against the dollar is trading at this price, or the pula against the dollar is trading at that price, or emalangeni against the dollar. Global currencies are moving up and down every single day. Now, what you and I want to do is we want to buy a particular currency, any currency. We're not limited to the dollar, by the way. We can buy any currency around the world as long as we're buying it at the cheapest price possible. So we want to wait for a particular currency to depreciate in value. Just before it starts picking up again, we want to go and buy that currency, buy as much of it as we can. Once we know and we are confident that from this particular price, it's going to start going up. So we want to buy there. And as the currency goes up, we obviously making money, because the value of what we bought is now appreciating. And eventually at a certain price, we're then going to go and sell it. And then that's how we make our profit. I'll give you an example. I'll give you a very practical example. In South Africa, during the 2010 World Cup, the price of the dollar against the rand, $1, during the 2010 World Cup, not right now, would have costed you R6.50. You can go and verify what I'm saying. $1 during the World Cup in South Africa in 2010, $1 was R6.50. R6.50. Now, if you bought that dollar in 2010 and you kept that dollar in your pocket, guess what? After the 2010 World Cup, the value of the dollar started going up because the rand started depreciating in value. And in a very short space of time, we hit 17 Rand 80. Now imagine then I say to you, now go and sell. Go and sell. We bought the dollar at R6.50. We're now selling at 17 Rand 80. It means we're not just making double our initial investment, we're making almost triple. Right? Now don't look at it. Don't look at it as buying $1. Imagine if I bought $10,000. How much profit was I going to make? If I bought $100,000, how much profit was I going to make? So the more money I'm trading with, the more currencies I can buy, and the more profit I can make, right? And hence, this is something else I want to touch on. We don't just make money when currencies go up. We also make money when currencies go down. And hence, what we do is we sell the currency while the value is high. We buy back the currency when the value is low, and we still make money. So whichever direction that the market is going, we can still make money. If currencies go up, buy it low, sell it high. When currencies go down, sell it high and buy it back low, you still make money. So what I'm trying to explain to those of us who are completely new is whether the price goes up or down, we can still make money. What we do need to do though is learn when should we enter trades and when should we exit trades. That's what we call entry points and exit points. If we can perfect that, if we can master that, we can make money almost every single day. And that's what I do for a living That's what our clients do every single day from all over the world. And hence, when prices go up, that's correct. We buy it at a low price, sell it at a high price. That's what we call going long. So I'd like you to write this down. Just say buy equals long. It's a long position. Then you say buy equal as in long, it's very long. So we don't use the word buy, we use the word long whenever we buy. And whenever we're selling, we don't use the word sell, we use the word short. So as in it's very short. Just say sell equals short, buy equals long. And when prices go up, we don't say it went up. We call that a bullish market, which is BULLISH, bullish. Maybe draw an arrow pointing up next to it, right? Bullish. And when prices go down, we call that a bearish market, which is BEARISH. So those are basics. Those are basics. Those are basics, right? Those are basics. Now, here's what I want to touch on. The reality is majority of traders lose money. That is the reality that very few people, find comfort in talking about. A lot of people don't even want to talk about that. So I'm going to talk about it tonight, that a lot of traders lose money. It's a fact. We can't run away from it. A lot of people lose money. In fact, majority, almost 90% of retail traders lose their money. And only about 5 to 10% plus minus actually make money. Now, here's what I want you to understand, right? Here's what I want you to understand before you dive into this industry and literally go all in, because I'm all in and I want you to be all in. When we trade, for a transaction to take place, there must be a buyer and a seller. That's how a transaction takes place. There must be a buyer and a seller. My trade cannot go through unless somebody's on the other side, placing the opposite position. Meaning, if there's nobody selling, I can't buy. If there's nobody buying, I can't sell, right? So there must be a buyer and a seller for a trade to go through. Sometimes some of us might have experienced that when you place a certain trade, the order doesn't go through. Sometimes you might find there's low liquidity in the market at certain times. Sometimes there's high liquidity in the market at certain times. You then experience what we call the widening of spreads, the adjusting of spreads. But the point I'm trying to make by explaining this to you is that every time somebody buys, somebody sells. It therefore means every time you make money, you must understand somebody lost money. Every time you lose money, it means somebody made money. Does that make sense? When you make money, that money doesn't come from heaven. It comes from somebody. When you lose money, that money is also not coming from heaven. It means, understand, because every time you buy, somebody sells. Now, that should not scare you. It shouldn't concern you or worry you. That should make you realize that knowledge is power. Because if you know what the average person doesn't know, you will avoid losing money and you will actually make money. Because the reality is, most people that get into this industry, they don't focus on getting information and knowledge and equipping themselves. Everybody's just driven by excitement that I want to make money, and they have no clue what's going on, and they end up losing money. Right. Now, this is what I want to share with you. Now that we've got the basics covered, this is what I want to share with you. I'm not even going to ask you this. I'm going to tell you. Most traders don't have a plan. That's a fact. Most traders don't have a plan, and that is a fact, right? Most people just open a trading account. They start jumping on YouTube, start following strangers on social media looking for strategies, and people lose money, right? So I'm saying to you tonight, if you are serious about making money, if you are sick and tired of losing money, if you're serious about generating an income stream, you're going to take what I'm about to say very, very seriously, right? Number one, if you want to succeed and be in this for the long run, you need to develop a trading plan. You can't run away from that. You need to have a trading plan. Your trading plan is like a business plan, right? I can't run a business unless I've got a business plan, right? People that are not serious about business, people who are in business just for the fame and just for the moment, excitement, They do those crazy type of things of just opening offices, hiring people, but there's no business plan. Those people generally don't last. So if you're serious about building an empire, you start off with a business plan and everything else follows. If you're serious about being successful in trading, you need to humble yourself and work on a solid trading plan. I'm going to help you put that together right now, right? Your trading plan must have everything. Everything you're going to do in the markets, it must be in your trading plan, right? When you take trades, you mustn't choose random lot sizes. You mustn't just use any random leverage. You mustn't choose any random stop loss and pip value. You know, that's an example of somebody who's gambling, who's not serious about trading. But if you're serious about trading, your lot size must be in your trading plan. Your leverage must be in your trading plan. Your pip value must be in your trading plan. Your stop loss must be in your trading. Your entire risk must be in your trading plan. How you enter trades must be in your trading plan. How you exit trades, your strategy must be in your trading plan. If you don't have that, I'm warning you, stop trading right now. Work on that trading plan. And if you don't, I guarantee you're going to lose all your money. And if you haven't started trading, work on that right now before you even put in your money in your account. And if you refuse to listen, you'll remember my words, guarantee. I've seen this happen over and over again. Now let's work on this trading plan. I'm going to help you step by step. Number one, in your trading plan, the first thing that I need you to have there, the first thing I need you to put in there is obviously the desired goal. That's the first thing we need to work on. The goal. How much are you looking at making in the next 12 months? Let's not set a 5-year plan or a 10-year plan. Let's just work on the next 12 months, right? You can work on your 10-year plan or 5-year plan. Let's focus on the next 12 months. How much money do you need to make? Let's not be unrealistic, right? Don't tell me $1 billion. If you know very well that's a dream. Let's set realistic goals. You want to pay off your car in the next 12 months? How much is that? Do you need 300,000? Do you need 100,000? Do you need $1 million? You want to buy a new house? You want to get married? Whatever you want to do, you know how much you need. There's nothing that annoys me. There's nothing that annoys me like people saying, I want financial freedom. What is financial freedom? Is it $1 million? Is it 10 million? What is financial freedom? So we need to be specific. And that's why people don't achieve their goals, because financial freedom can be anything. $1 billion can be financial freedom. 10 million can be fine. So we need to start being specific. I need 1.2 million. That is a specific goal. It's not financial freedom, or I want to be rich, or I want to be successful. I want to make 1.2 million. That must be the first thing on my trading plan. But I'm not, that's just an example I'm giving you, right? You write your own, you know what you want. So have that down. So if I'm saying I want to make 1.2 million, now that is my goal for the next 12 months, which must be in my trading plan. Then what I then need to do is I now need to break down this into 12 months. I now need to take this 1.2 million divided by 12 months, which will give me what, 100,000 a month. That's my monthly target. That in a month, I just need to make 100,000. If I can make 100,000 consistently for 12 months, I will make my target of 1.2 million rand. Right now, I'm going to take my 100,000, which is my monthly goal. I'm going to divide it by 4 weeks in a month. There are 4 weeks in a month, which will therefore mean in a week, I need to make 25,000. That's it. I just need to make 25,000 in a week. If I can make 25,000 for 4 weeks consistently, I'm going to make my 100,000. You take your 25,000, which is your weekly goal, divided by 5 trading days in a week, you will then get your daily target. Your daily target, which will be how much? It will be 5,000 rand. That's what I need to make a day. If I can make 5,000 rand a day, 5 days in a week, I've got 25, 4 weeks in a month, I've got 100,000, 12 months in a year, I've got 1.2 million. That must be in my trading plan, right? Now you might think this, what does this have to do with trading? I'm getting there. Once once I have a daily target, it changes the game. Because now all of a sudden, it's no longer about me placing 5 trades. It's no longer about me placing 10 trades. If I was to ask some of us who are trading here, I promise you, a lot of you will give me very random answers. If I ask you how many trades you place in a day, some of you will give me random numbers. I place 3 trades, I place 5 trades, I place 2 trades, I place 10 trades. But if I were to ask you, why do you place 5 trades in a day? It'll be difficult to give me a valid reason. Because it's not the quantity of trades that you place that makes you successful. It's the quality of the trade, right? Whether you're placing 5 trades or 10 trades, that's immaterial. What's important is, based on my goal, I need to make 5,000 Rand. Whether I'll make this 5,000 Rand on 1 trade or 5 trades or 10 trades, that doesn't mean anything. What's important is I need to make 5,000, which is my daily target, and everything then obviously ties up to my goal for the end of the year. Now, once I've got that in place, that's when I can begin to work everything backwards. I'm working backwards, right? And what I mean by saying I'm working backwards, now I can begin to say, okay, Simple said, for me to make 5,000 Rand a day, it means I must use a leverage of X amount. For me to make this 5,000 Rand a day, I need, for example, to trade with the pip value of 100 Rand, a pip. And if my pip value is 100 Rand, I need to target 50 pips. Because if you say 100 Rand per pip, which is the value of 1 pip, multiplied by 50 pips, it'll give me 5,000. So I'm now beginning to implement my goal in my trading platform, right? I need to use a leverage of X amount. I need to trade with the pip value of $100. I need to target 50 pips in a day, and I'll be able to make 5,000. We're no longer daydreaming. We are no longer daydreaming, right? We're no longer daydreaming. We are now calculating, and we're now working on a solid plan to make that a reality, right? We're not trading based on emotions or excitement, and we're hoping we're going to be rich. We are calculating our steps to becoming rich, right? So I now need to have a set pip value. I need to have a set number of pips per day. I then need to have a set volume, which is my lot size. I need to have a specific volume, a specific lot size that needs to be used in order for me to achieve that goal. I hope we're still all on the same page, right? Now, let me quickly explain this. I know I've thrown a couple of words that some of us might not know or understand. I'm gonna explain it to you. So the first thing I want to explain before I go, I'm gonna explain these things on the actual charts, but I want to just break this down. What is leverage? What is leverage? Leverage is what we use as traders to get a bigger exposure in the market than what we initially funded. So when you start trading, especially for those of us who are new, you will get 2 options. You can open what we call a demo account, which is a practice account. It's not real money. So you can open a demo account and just practice on that. That will not cost you anything. So in fact, everybody should have a demo account because it's free. Demo account, leverage doesn't matter there. But when you open a real account, a live account, that's where you now put in real money. And that's where leverage comes in. Because when you open a real account, you get to choose what leverage you want to use. There's a leverage of 1:10. There's a leverage of 1:20, 1:50, 1:100, 1:200, 1:500, 1:1,000, 1:2,000. There's different options when it comes to leverage. Now, I want you to understand this. If you choose a leverage of 1:100, it means whatever amount of money you've put into your trading account, you'll be able to trade 100 times that. Does that make sense? Which means if I go and put in, R1 million in my account, if I go and put in R1 million in my trading account, if I put in R1 million in my trading account and I'm using a leverage of 1:100, even though I've funded R1 million, I will be able to trade currencies that are 100 times that million. Which means with my 1 million Rand, I can trade currencies of volumes that are up to 100 million. I don't have 100 million. I only put in 1 million. But because of leverage, I can trade up to 100 million. That's why we're able to grow our money a little bit faster in trading. I can also choose a leverage size. I can choose a leverage size of even 1:1,000. If I choose a leverage size of 1:1,000, look at this. Look at this. I can go and fund 1,000 Rand. Literally 1,000 South African Rand I put into my trading account. I use a leverage of 1:1,000. If you say 1,000 times 1,000 Rand, that's 1,000,000. Which means even though I funded 1,000 Rand, I can trade currencies of up to 1,000,000 Rand because that's 1:1,000. And hence, I will be able to make far bigger profits with a small amount of money. So in brackets, when you're writing down your notes, you can also say leverage is like credit. Leverage is like credit. But the nice thing about it, this is not credit that you will need to pay back. This is what it's a facility. It's a facility that brokers will give you in order to get bigger exposure when you trade. So think of it this way in simple terms, guys. If I've got 1,000,000 Rand and I want to buy a house and I don't want to use leverage, what I will do with my 1,000,000, I will go and look for a house that is worth 1,000,000. I've got 1,000,000 Rand. I go and look for a house worth 1,000,000. There's no leverage there because it's 1:1. My 1,000,000 Rand is getting me a house that is worth 1,000,000. So if my property appreciates by 20%, I'm making 20% return on my investment of 1,000,000, which is 200,000. But now how can I apply leverage with the same amount of money? If I was to apply leverage, what I would do, instead of buying a house worth 1,000,000, I can go to the bank and say to the bank, can you borrow me 10 million? Borrow me 10 million Rand. I've got 1,000,000 Rand in my account right now. Borrow me 10 million. The bank gives me 10 million. Now look at this. Instead of buying a property that is worth 1 million, I can now buy a property that is worth 10 million. And if the property market goes up by 20%, I'm not making 200,000. I'm making 20% of the 10 million, which is 2 million Rand instead of 200,000. You realize now that leverage has allowed me to make far more money than what I would have if there was no leverage. That is the power of leverage. That is the power of leverage. And I want all of us to use that to our advantage when we trade. But here's the thing. I don't want to mislead you, right? I want to tell you the good and I'm going to tell you the bad, right? I'm going to be honest with you. The bad side or the downside of leverage is as much as the profits will be high, your losses will also be just as high. Does that make sense? Because if I borrow 10 million from the bank and the market doesn't go up by 20%, instead it goes down by 20%, I'm no longer losing 20% of my million. I'm losing 20% of 10 million, which actually means I lose all of my money, plus I owe the bank money. Does that make sense? So I need everybody to understand this. A high leverage will make you a lot. It will also cost you a lot. A low leverage will make you less money, but you will lose less money if you do lose some trades. So what you want to do is you don't want to go extremely high. You also don't want to go extremely low when you're choosing your leverage. You want to try and find something that is in between. And I'll just share with you tonight that personally, I use a leverage of 1:100. Even though I said to you, there's a 1:10, 1:50, 1:100, there's even 1:500, 1:1,000, there's 1:2,000. But personally, I use 1:100. I am scared of using 1:1,000. I can tell you right now, I am scared of using, with all of the money I have, I'm scared of using 1:1,000. It's too high. It's too high. And those of us who were saying to me earlier on Sandile, I keep losing money in the markets. The reason why you probably keep blowing accounts, go and check your leverage. You might be shocked. You might go and check your leverage. If your leverage is 1:500 or 1:1,000, that's probably why. It might not be the only reason, but that is definitely a contributing factor as to why when you lose money, you lose big sums of money. When you make money, it's small sums, right? The psychology of trading might also be playing, a role there, right? But I know leverage for a fact, it plays a massive role when people lose money. So that is leverage. Let me quickly share my screen, right? I'm going to turn off my video, so you're not going to see my face right now. I want to share my screen with you, right? I want to share my screen with you. I don't have $1 billion. Is it Emmanuel? I wish I had $1 billion. I don't have $1 billion. I wish I had $1 billion. But we're going to get to the billion. Trust me, we're going to get to the billion. But I don't have $1 billion. So I'm going to share my screen out, and I want to take you to my trading account quickly and explain a few things as well. I want to explain some very, very important things here. This is my trading account. So this is what I use, to buy and sell these different currencies. There's some very fundamental things that I want to touch on here, right? Before I show you something incredibly fascinating. On my screen, I've got a chart of, if you look on the top left-hand corner, it says NZDCHF. This is the New Zealand dollar against the Switzerland franc, right? And what this actually means, is 1 New Zealand dollar. In fact, you know what? Let me not use this currency pair. Let me use something that we're familiar with. Let me use something that we are all familiar with, which is probably our euro. Euro USD. We all are quite familiar with the euro and the dollar, right? So this chart that I've just opened up now, it's a euro USD. So all of these candlesticks that are moving up and down, they are representing the performance of the dollar against the euro, or the euro against the dollar. As the euro and the dollar have been trading in the past couple of days, this is what has been happening. So I've got green and red candles here. These candlesticks, or this graph, is representing what has been happening on the euro and the dollar. Now, the very last candle on the right-hand side, this is the representation of the current price. So this is where the price is right now, and that gray line. So that gray line and the last candle on your right will always be the current price. And all the candles before that, that is our historical prices. So in the market, we have a current and a historical price, but we don't have a future price. Now, what this exchange rate, so you see these numbers on the right-hand side, this is the exchange rate. And the current rate that the market is trading on is this gray line, which is the last candle. That rate is actually telling us the following, that 1 euro is equivalent to $1.18005. That's what that price or that exchange rate means. That for every 1 euro, I must pay $1.18005 US dollars. Now, what generally happens is this. When we trade, we want to buy this very low. If you look at that candle right there at the bottom, or maybe let me not even go that far. Let's look at right here. This is what happened today. If you look right there at the bottom, these candles, the market was trading at 1.17608. I could have bought at that red line, and as these candles were going up, the value of the euro was going up, and therefore I've been making money. As the euro was going up, I was making money because I bought the euro for that price, and now all of a sudden this euro is now worth that price. So I'm going to turn that into a green. So I bought at this red line and I sold at that green line. If you look at the price where that red line is and where that green line is, there's a difference there. So I would have bought it at a cheaper price and sold it at a higher price, and as a result I would have made money because there's a difference there in price. I would have made money. Now what happens is that when prices go up and down in the currency market, we don't say it went up by so many euros or it went down by so many dollars. We use what is called pips. But I know this might be a new word for those of us who just are still new to trading, but I'm hoping that I'm going to try and make this as simple as I possibly can. So when we talk about pips, we are talking about points. When we talk about pips, we are basically talking about points, right? When the market moves we express or we calculate that movement, or express that change in price in points or pips. And one of the reasons being is when the market changes price, when the market either moves up or down, you might realize that it doesn't go from $1 per euro to $10. It doesn't change that much. It will go from 1.18 to maybe 1.19. So the difference as the market trades every day, it changes by a couple of cents. It changes by a couple of decimals. That's why we don't say it went up by 2 euros or it went up by $2. We use points, which are basically pips, which are decimals. Now, when we calculate these points, which is critical in calculating risk or managing your risk in trading, we focus on the first 4 decimals. Whenever you're calculating your pips, for majority, not all of them, for majority of our currencies or currency pairs, that is, we use our first 4 decimals. Some currency pairs that have like your Japanese yen and so on, we use, we only focus on the first 2 decimals. And the reason why, if you go beyond 4 decimals, it's no longer pips. It's now what we call pipettes. All right, so once you go up to 5 decimals, it's no longer pips. It's now pipettes. So what generally happens is some brokers or some platforms that we trade on, they quote currencies in pips. Some platforms quote currencies in pipettes. Now, please don't get confused. A pipette is a tenth of a pip. The relationship between pips and pipettes is the same as centimeters and millimeters. 1 centimeter is equal to 10 millimeters. 1 pipette, or rather 1 pip is equal to 10 pipettes. So that's why we say a pipette is a tenth of a pip. But let's just focus on pips for today. I don't want to confuse you, right? Let's look at that price at the bottom. That red line. That red line is at 1.1760. Now, that is 4 decimals, right? We're trying to calculate the pips now. That is 4 decimals, 1.1760. I can see that there's an 8 after the 0, but I'm going to ignore that because if we're calculating pips or points, we can't go beyond 4. My green line where we're going to sell or where we're closing our trade is at 1.1831, and that's where I'm going to end it. Only first 4 decimals. I can see there's a 6 after the 1, but I'm going to ignore that. Now, what I'm going to do is I want to calculate the difference between these 2 prices, because whatever answer I'm going to get from these 2, that will be the number of pips. So when you hear somebody saying, how many pips did you make today? This is what they're talking about. When we say how many pips did we make today, this is what we are referring to. So I'm going to say 1.1760 minus 1.1831. The answer I'm getting on my calculator, I could be wrong, but I'm quite confident that I am right. The answer I'm getting is as follows. This is the answer this device is giving me, 0.0071, which actually means this is 71 pips, because there are 2 zeros in front of the 7, right? Because there are 2 zeros in front of the 7, it means it's 71 pips or 71 points. If there was a 1 in front, of the 7, it was going to be 171 pips or 171 points. So that is 71 pips. That is 71 pips. Now you might be wondering, Sandile, why is this important? Why is this important? The reason why this is important, yes, it is, Zakele, that is a live account. That is a live account. The recommended leverage is 1:100. The recommended leverage is 1:100. The reason why that is important, ladies and gentlemen, the reason why this is important is because this is what I was talking about when I said the quality of your trade is more important than the quantity of trades. So don't rush into placing 20 trades or 5 trades or 3 trades. This is what is important. When you trade every day, you need to try and bank as many pips as you can, not as many trades as you can, because what's the point of placing 5 trades and you are making about 15 pips per trade? You want to take one good trade and make about 70 or 100 pips in one specific trade. Now, once I have the number of pips, I now want to show you something, right? I'm going to take you to our company website. Now, when you get onto our company website, right, what I've done is we actually rebranded. So just in case you're wondering, hey, Sandile, what is this now? What is ItradeFX? We actually rebranded our company in beginning of 2020. And we're trying to, you know, change our business model slightly into providing traders with relevant tools. We're trying to provide traders with relevant tools that will help traders, you know, become a little bit more efficient in the market, a little bit more effective, and gain even more confidence to make money. So you will see that on our company website, it says trading tools. And one of the tools I want to show you, which will help you when it comes to risk management, is the calculator. So there's so many different tools that you can use here. I'll just show you one quick one. If you go into market review, we've got an ebook here. We've got an ebook that you can just literally read in your spare time. It will explain to you what is Forex, the history of Forex, different trading sessions, you know, your base currency, cold currency. It will explain to you what is leverage. It's on our ebook. What is the margin? It's on our ebook. What are pips? What are pipettes? It's on our ebook. Your bid price, your ask price, your spread, it's on our ebook. You know, what is a lot size? You know, your standard lot, your mini lot, your micro lot, all of this information, your pending orders, it's on this ebook. Calculating your margin, guys, calculating your margin, right? So you need to make a decision. Do you want to get this information and do the right thing, or do you want to keep losing money? Right? Now, this calculator is what all our clients are using currently to minimize their risk and maximize their profits. Now, what you want to do here is just put in how much money you are trading with. I'm just going to use $1,000 just for example purposes. And then below that, I need to put in my position leverage. Now, even though I said to you, I'm using a leverage of 1:100, I'm not going to put in the entire 100 here. And I'm going to tell you why. If I put in the entire 100 here, it'll mean I'm risking my entire account. So I'm going to choose a small percentage of my total leverage, and I'm going to go for 10% of my leverage just for calculation purposes. It doesn't mean I'm using a leverage of 1:10. Just for risk management purposes, I'm going to use 10% of the total leverage because I'm trying to calculate the risk I'm going to take per position, which is per trade. And then below that, you just put in whatever percentage return on investment you want to make. That is up to you. You can target 70%, 10%, 1%, whatever return you're comfortable making. Some people are more aggressive, some people are not. But once you do that, look what our calculator does. Our calculator tells you how much you will be sitting on month 1 if you make that 40%. By month 3, by month 5, look where I'll be by month 12. Starting with $1,000, if I maintain this 40% consistently, starting with $1,000, guys, is about 17,000 Rand. Starting with about 17,000 Rand, if I maintain that consistently, by month 12, I'll be sitting with $56,000, which is actually over 700,000 Rands. Over 700,000 Rands, which means I'm a quarter, you know, that's 3 quarters, in fact. That's 3 quarters of a million. Now, there's something critical on the left-hand side here, which is what we call a pip value. This calculator doesn't just only give you projections. You remember, these projections is what I said you need to have in your trading plan. These projections is what I was talking about earlier on, that you need to know exactly where do you want to be by month 12. And then once you know where you're going to be by month 12, you can then begin to work backwards. Have a clear timeline. You need to have a clear timeline that in January, that's where I must be. February, March, April, May, by June, that's where I must be. Those are just projections. But what's important is now, how are we going to get there? That is where the leverage comes in. You need to have a set leverage. Then there's something called a pip value, which is actually what I wanted to quickly jump onto. Right? We've now calculated. We've calculated as to how many pips are there. Right? We've calculated that on this trade, there's 71 pips. If we buy there and close our trade there, we will make 71 pips. But now there's something that is missing, which is what is the value of 1 pip? Because 71 pips is not $71. Please write that down if you need to. 71 pips is not $71 because 1 pip is not equivalent to $1. The value of your pip is influenced by how much money you are trading with, right? So hence why I need to go and calculate my pip value on our company calculator. I'll show you something quickly. Let me show you something. If I increase my initial capital, if I increase my balance, the capital in dollars that I'm trading with, look what happens to my pip value. My pip value all of a sudden is now $10,000. If I decrease my pip value, look now, it's $10. If I decrease it more, it's now $1. If I drop my account to $100, look at my pip value. It's now $0.1. If I decrease it even more, right? So the amount of money you are trading with is what will determine what your pip value is. Not only your balance, but even your leverage. And this is where a lot of us screw ourselves over. This is where a lot of us go wrong. This is where we get it completely wrong. I'll show you something that if I increase the leverage without even increasing my balance, and that's why I say some of you guys are blowing accounts, not because of anything, but because you're using the wrong leverage. Look at this. If I increase my leverage, my pip value increases, and you don't even know this. You don't even know this. You use a big leverage, you end up risking a massive amount per pip, and you lose big amounts, and you don't understand why. So your pip value is influenced by 2 things: the amount of money you have, as well as your leverage. The higher your pip value, the higher your leverage is, the more money you're trading with, the bigger your pip value is. In my case, my pip value, just based on this example, the value of 1 pip is $1. So then it's easy for me to know how much money was I going to make on this trade, because all I'm going to do is I'm going to say 71 pips multiplied by my pip value of $1, and I'm just going to say in brackets pip value. Therefore, it equals to, that is equal to, I was going to make $71 on this specific trade. This is the importance of knowing your pip value, because your pip value, ladies and gentlemen, does not just apply when it comes to calculating your profits. Let me repeat that. Your pip value does not just apply when it comes to calculating your profits. Your pip value does not just apply when it comes to calculating your profits. And I'll repeat that. Your pip value also helps you when it comes to calculating your losses. There's something called a stop loss when we trade. There's something called a stop loss. This is a tool that a lot of traders use. But a stop loss is a feature that we use to minimize our losses in trading. Meaning, if I buy at this price, I'm buying because I hope the market is going to go down up. Or maybe let me not say hope, because I'm confident it's going to go up. But now, remember, I don't control the markets. Sandile doesn't control the markets. I trade the market. So even though I'm confident it's going to go up, there's quite a number of things that could, change everything, and the market ends up going down. There's so many external factors that need to be taken into consideration. Something can happen that we were not able to foresee, and the market ends up going down. If the market goes down, I must not be in a position where I now lose all my money. That's where the stop loss comes in. I can now, as a trader, say, okay, if I buy at this price, if I buy here, and I'm speculating that it's going to go up. If it goes down, I need to put a stop loss somewhere there. Now, the biggest problem with traders is that they just put their stop loss anywhere. Some people, I know a lot of people use, the previous low if you're buying, previous high if you're selling, but a lot of people just go and place their stop loss anywhere and they hope they don't lose all their money. No. Your pip value is what needs to determine how far your stop loss is, and I'm going to tell you why. If my pip value is $1, already I know that if I put my stop loss 10 pips away from my entry, I'm going to lose $10 because I know my pip value. I know my pip value. If I put my stop loss 20 pips away from my entry price, what is 20 pips times $1? It means I'm going to lose $20. If I put my stop loss 30 pips away from the entry price, I'm going to lose $30. So all of a sudden, even the amount of money I'm going to lose is not a guessing game. I don't guess how much I'm going to make or lose. I calculate it so that nothing is a gamble. Nothing should surprise me. The amount of money I make, the amount of money I might lose, it must be calculated. It must be calculated to the T. It needs to be calculated to the very last pip. Right, then there's one last thing I want to show you here quickly. There's one last thing I want to show you. When I click on that button, right, that green button, I will be able to buy the Euro USD. Right, but there's something that I want to specifically point out. Your euro is your base currency. Please write that down. Not just euro, whatever currency that is on the left-hand side, that will be what we call a base. That is the base currency. My dollar is the quote currency. So my euro is the base, the dollar is the quote. Now, whenever I buy, I'm actually buying the base and I'm selling the quote. Whenever I sell, I'm selling the base and I'm doing the opposite to the quote. So if I click the button buy, if I click on that green button, I'll be able to buy. If I click on that red button, I'll be able to sell. But what I'm actually buying, I'm buying the euro and I'm selling the dollar. If I click sell, I'm selling the euro and I'm buying the dollar. So whatever action you are taking, you're actually doing it to the base, and the opposite will happen to the quote. So when I buy, I'm actually buying the euro. And there's something very critical, which is called volume. Please write that down. Guys, all of these things that I'm sharing with you, this is not random information. This is information that must be in your trading plan, right? Your pip value must be in your trading plan. Your leverage must be in your trading plan. Your goal for the year must be in your trading plan. Your daily target must be in your trading plan. And most importantly, your volume, which is your lot size, must be in your trading plan. In other words, you mustn't choose any random volume or any random lot size. Your volume and lot size is the same thing. It's the same thing. This is 0.1 lot size, which is actually one mini lot. There's what we call a standard lot, a mini lot, a micro lot, a nano lot. But I'm not gonna focus on that because I don't wanna make this, confusing. I'm just gonna give you the formula on how to calculate this. But before I give you the formula on calculating your volume, I want to first explain to you what is volume and what is the significance of it. Why is it important? Why is it worth me explaining it? When I'm buying the euro right now, as I'm about to buy this euro, I, as the owner of this trading account, right, I've got about 4.9 million US dollars on this account. As you can see there at the top, this is a real account. This is not some demo account. And there it says USD. Currently, I'm holding a negative position on gold, but that's the balance I've got. I've got about 4.9 million US dollars, which is over 70 million rands. So I now need to decide, as the owner of this account, how much of this money do I want to spend on this trade? So in other words, your volume is what we use as traders to determine the quantity of euros we want to buy. So I can decide to maybe buy 1,000 euros, or I might want to buy 100 euros, or I might want to buy 1,000,000 euros, or 100,000 euros, or 500,000 euros. The number of euros, which is the quantity, is determined by my volume. So your volume controls the size of your trade, the quantity that you are buying. So as a result, if I increase my volume, I'm increasing the number of euros I'm buying. And as a result, I'm increasing the risk that I'm taking on the trade. If I decrease the volume, I'm decreasing the number of euros or the quantity that I'm buying, and therefore I'm decreasing the risk. Now, a lot of people don't understand, how to adjust their volume. People just use any random volume. So I want to give you a formula. This formula is also obviously dependent on the type of account you've got. Is it a standard account? Is it a micro account? But this will generally work for most accounts. But also, as I said, depending on what type of account. So you can take your pip value divided by 10. That's the easiest way to get your volume. Take your pip value divided by 10. Take your pip value divided by 10. Remember, your pip value, your lot size, your lot size is your volume. Your lot size is your volume. Your lot size is your volume. So I'm going to take my pip value. My pip value in this case is $1, right? So I'm going to take this $1, which is my pip value. Now, to get my volume, I'm going to take that pip value of $1. Take that $1 divided by 10. So my pip value is 1 USD. Divide that by 10. As a result, my volume is going to be what? It's going to be 0.1. Now, when we say 0.1, it is 0.1 lots. So this is volume, but when we get the actual answer, 0.1, that is the number of lots. So when we say lot size and volume, that's why I say it's the same thing. So the 0.1 is the number of lots, but this is all my volume. So volume is the size of the quantity, the number, or the size of my position. So now, if I go and buy right now with 0.03, I now know that is wrong. That is wrong. That is too low based on the size of my account. So I now need to increase this until it gets to 0.1. Now, do you realize, guys, this is what I was saying to you earlier on, that when you trade, you need to trade with knowledge and information so that when you make these decisions, you are not gambling.